It's becoming more common these days for Australians to move overseas, and often that can, but not always, mean that you will be exiting the Australian tax system as well. So for those that do exit the tax system, the good news is you can keep your shares and continue earning income from them, but there are some things that you do need to be aware of because the way that you are taxed will change. In this video, we're going to explain to you how the non-residence tax system in Australia works for shareholders, what you have to watch out for, and also what you need to know in order to optimize your share portfolio after you do leave the Australian tax system. And now I do have to say here that everything I'm talking about is general in nature. There might be some nuances or differences in your particular situation, so I strongly urge anyone who's interested in exiting the Australian tax system and who wants to know more about what their tax implications may be to seek professional tax advice before you go ahead and make a big move. So basically, the taxation on shares when you leave the Australian tax system falls into two main parts: tax on capital and tax on income. First, we'll look at tax on capital, and here we're talking about the exit tax, which you may have heard of. Basically, what the exit tax means is that when you become a non-resident, so you leave the Australian tax system, you go to live somewhere else, the Australian Tax Office will treat that as a capital gains tax event, even if you did not dispose of your shares. So on paper, you would be deemed to have disposed of your shares, even though you still have them. And what this means is there will be a tax event on these shares and probably a capital gains tax liability if your shares are worth more now than at the time when you bought them. Now, what does that mean? It means that you may indeed actually have to sell a parcel of shares in order to come up with the funds to pay off this exit tax, or you might have to put in some cash from outside your portfolio to pay that tax liability on your exit tax return. The good news is, because you are deemed to have disposed of your shares on the day you become a non-resident for tax purposes, this means that there is no capital gains tax going forward while you remain a non-resident in Australia. So yes, there can be a bit of pain getting out the door, but once you are out the door, there is potentially a lot of upside potential for your portfolio with any gains that you may make into the future. So at this time, you may have a tax liability, and then you're looking for ways to minimize that tax liability. So you might be looking at certain assets that you wanted to offload anyway. You may have assets that were making a loss so that you can sell them and then offset that loss against the gain. There is also an option to disregard or defer the capital gain on the exit tax event. But be careful with this. While this might sound good today, it could turn out to be a very bad decision in 5 or 10 years' time. So definitely be careful with doing that. Now, the second part of the equation is tax on income or dividends. And here, a very important concept is looking at the difference between franked dividends and unfranked dividends. Very quickly, the difference is a franked dividend is a dividend that the company that has paid the dividend, that company, it could be like BHP or Commonwealth Bank, someone like that, they have already paid corporate tax and have credits against that corporate tax they have paid. So you get a 30% imputation credit or franking credit against that. An unfranked dividend is simply a dividend from a company that has not paid corporate tax on that dividend and did not have franking credits either available or that they did not want to use against this particular dividend. So there is no 30% tax credit on an unfranked dividend. So with franked dividends, how that basically works is that they are not subject to tax in Australia for non-residents. And how that works in practice is that you are just foregoing that franking credit. So if a company, BHP or Commonwealth Bank, paid you a dividend of $100, or rather they paid you a dividend of $70, and there was a $30 franking credit to make a gross dividend of $100, they paid the 30% tax to the government, that's the franking portion, they paid you $70 as a franked dividend, you would keep that $70 and basically ignore that $30 franking credit. So at the end of the day, you're essentially paying 30% on the gross dividend. Now for unfranked dividends, they are subject to a withholding tax, which on the Australian side is 30%, unless there is a double taxation agreement between Australia and the country where you are now a resident. The good news is most countries do have a DTA with Australia, and many of these DTAs, double taxation agreements, have a provision in there that limits the withholding tax to 15%. But you're going to have to review the tax treaty, the DTA, on a case-by-case basis, depending on where you now live. Another variable to this is foreign conduit income. This is basically a share that you own in an American company or an English company, anywhere but not an Australian company. Foreign income is not taxable in Australia to non-residents. So there is no withholding tax attached to dividends from foreign companies that you may own on the ASX. But that doesn't necessarily mean that it's tax-free, because that company in the US or in the UK would have probably paid some company tax in that country, and that is basically the tax that you're going to wear. So you're not getting a withholding tax in Australia, but you're not getting a credit for the tax that was paid overseas either. So they are the main principles around how Aussie share portfolios are taxed for non-resident shareholders. For some people, they may choose to liquidate their portfolio before they leave. For other people, it might be better off holding onto it for tax reasons, or maybe they just want to keep some exposure to the Australian market as well, even though it means perhaps paying a bit more tax. If you're interested in this, or if you're thinking about moving overseas, feel free to get in touch. We can do a tax assessment, do some pre-exit tax planning, and sort of identify ways to optimize your portfolio, not just through the exit, but also out on the other side once you have become a non-tax resident. If you're interested in that, head over to offshoreinasia.com. You can book in a consult call there. You can also send us a contact form, and we can start the conversation from there and see if we can get you a good tax outcome. Thank you for watching, guys. We'll see you later.